A company's earnings could make or break your dividend investments. Imagine investing in a high-yield dividend stock, only to watch your income vanish overnight. Today, I'm going to reveal why understanding earnings is absolutely crucial for making smart dividend investment choices. Hello, I'm Steven. With over 10 years of experience in investment banking and serving as a key finance executive for Fortune 500 companies, I've seen firsthand how earnings impact dividend sustainability. In this video, we'll dive deep into the world of dividend investing to uncover the critical role earnings play. Stay tuned, because what you're about to learn could save you from costly investment mistakes. When it comes to dividend investing, many focus solely on the dividend itself, the income paid out to shareholders. But there's a crucial element that often gets overlooked: earnings. Earnings are the lifeblood of any company, playing a critical role in maintaining and growing dividend payouts. Without a strong earnings foundation, even the most attractive dividend can quickly turn into a liability. Many dividend investors have experienced investing in a company with a juicy dividend yield, only to have the rug pulled out from under them when the company cuts or suspends its dividend. It's a painful experience and can be a major blow to your portfolio. More often than not, the warning signs were there. The company's earnings had been declining, and it was only a matter of time before the dividend got cut. Companies usually reduce or suspend their dividends when facing financial strain. It could be due to declining sales, increased competition, or poor management decisions. Whatever the reason, the result is the same: a dividend that's no longer sustainable. But here's where it gets interesting. Understanding a company's earnings can give you critical insight into the reliability of its dividend. In just a moment, I'll share how you can analyze earnings trends to make more informed investment decisions. The reality is that dividends are a luxury companies can only afford if they're generating enough earnings to support them. If earnings start to decline, the dividend is often the first thing to be cut. It's a harsh truth, but one that dividend investors need to be aware of. On the flip side, companies with strong earnings can afford to be more generous with their dividends. They can increase their payouts over time, providing a growing income stream for shareholders. That's exactly what dividend investors are looking for: a steady and growing income stream to help achieve financial goals. Let's take a look at Johnson & Johnson, for example. Johnson & Johnson has a long history of increasing its dividend payouts. Thanks to strong earnings growth, the company has a diversified portfolio of pharmaceuticals, medical devices, and consumer products, allowing it to generate consistent earnings over the years. As the company's earnings have grown, so has its dividend. Contrast that with a company like General Electric. General Electric's earnings have been in decline for years, significantly impacting its dividend. In 2018, General Electric was forced to cut its dividend by 50%, sending shockwaves through the dividend investing community. It was a painful reminder that earnings matter and that a declining earnings trend can quickly put a dividend at risk. But how can you, as an investor, use this information to your advantage? Stay with me, because I'm about to reveal practical tips on evaluating dividend stocks based on their earnings performance. Understanding a company's earnings provides critical insight into the sustainability of its dividend. By examining earnings trends, investors can assess whether a dividend is sustainable. Look for companies with a history of consistent earnings growth, as this often correlates with reliable and growing dividends. Take Coca-Cola, for example. Coca-Cola has a long history of generating strong earnings growth, enabling the company to increase its dividend payouts consistently over the years. By examining Coca-Cola's earnings trend, investors gain confidence in the company's ability to maintain and grow its dividend. So, what's the key takeaway here? Earnings are absolutely crucial for dividend investors. They provide the foundation for dividend payouts and offer insight into the reliability of those payouts. By understanding a company's earnings, you can make more informed investment decisions and avoid being caught off guard by dividend cuts or suspensions. In the world of dividend investing, earnings matter. They're the engine that drives dividend growth and can make the difference between a successful investment and a disappointing one. Next time you evaluate a dividend stock, remember to take a close look at the company's earnings. It could be the difference between a steady income stream and a major setback. If you found this video helpful, please give it a thumbs up and consider subscribing to the Money Mentor Hub for more investing insights. I'd love to hear your thoughts on earnings and dividends in the comments below. Have you ever been surprised by a dividend cut? Share your experiences so we can all learn together. Before you go, be sure to check out the video appearing on your screen right now. Trust me, you don't want to miss it. See you in the next one.